Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta. Well, let's start up with the roundup of a recap of the week that was for commodities. And starting off with the crude oil prices, well, it really has been about the supply disruption concerns which have been supportive for the crude oil prices. So whether it was the US or the Brent or the Indian crude oil prices, we seem to be closing the week on a higher levels today. It also had to do with the safe haven demand, which took the precious metal prices on the higher side. So you have the gold prices trading at a one-year highs, and the silver prices as well made new highs in the global markets and the Indian markets as well. For precious metals especially, it was about the weak US dollar, the geopolitical concerns, expectations that the Europe and US would not move so fast on interest rates, and of course the fact that you also are looking at physical and ETF buying has taken those prices higher. And it is about the supply disruption concerns which took the base metal prices higher as well. Whether it's on the weekly basis or the monthly basis, you have seen all of those metals actually continue to run up. The outperformance, of course, coming in from nickel, where you have seen 4% of gains, 16% up in this month now. And copper, of course, has been the other one, which is trading at a 3-year highs on this week as well. So it has been a buzzing week for the commodity space, but will this rally continue? Let's discuss that further with Jonathan Bharat, and he joins us on the show to talk about that. Jonathan, hi. I want to talk, or rather start with the metal space, because that has seen a phenomenal run in the last couple of months on the back of strong fundamentals, starting right from China, environment protection, strong data, good buying, and of course supply concerns as well. But from here on, as we look at the metals which are slightly overstretched and perhaps overbought as well, how are you looking at the future course?
Well, I think generally, I mean, the metals have had certainly a very large move. I think you've got to think that after such a move that we've got to see some form of correction. And I think when I look at the market, you know, we're at sort of, we look at copper 3-month highs, you know, and you start to get a sense that we are due for correction. I sort of like the complex overall because, as you know, we still remain in a contango for many of the metals, but I think a good correction from here would be only make way for further gains.
So, Jonathan, would you look at any correction at these current levels and consolidation before we see yet another leg up coming in for many of these metals?
I think when I look at it, I still you know, look at copper, and I think where copper is trading, it's quite an interesting dynamic at play. First of all, we've obviously got a weaker dollar, but we've also got supply concerns in that market. That's certainly helping to keep prices at these levels. So I guess when I look at it, I'd like to see the copper to consolidate. You know, we're around that 7,000 mark. I would like to see it come back before it pushes on.
As you said, Jonathan, you would want to pick up on copper as your best bet when it comes to the base metal prices. But what is your sense on how much of a risk-reward ratio would you see onto this one? How much of a downside? And then what kind of an upside or a closing basis for this year from here on?
Look, I think when you look at copper where it is at the moment, I would like to see it. If it can 10%, I think that would be very healthy. You know, that does see it into those 6,300, 6,400. You know, and I think that by maintaining that level and that with that correction, given what we're seeing in the fundamental market, should still be quite supportive. And then if I can see copper up after that, break through these highs again, then you could see another 10 to 15% on the top side. So when you look at that whole complex for copper, particularly also how the copper markets are with its contango, that it bodes very well for the metal towards the end of the year. End of the year, if I can see around 7,500, maybe a little bit higher, I'll be quite happy with it.
Well, that's about the metal space, where the copper prices can see 10 to 15% of gains, and $7,500 per ton on LME is the level that Jonathan is watching out for. But let's talk about gold prices now, and we've seen a tremendous run up here. The last 1 month has seen $100 come in as well, Jonathan. What a terrific run up, but the technical levels, how are they looking to you now, and how much higher from these current 1350 levels do you see gold headed to?
Well, I think you hit the nail on the head. We have good technicals that have come to play in the market. There are geopolitical issues there that are supporting it and seeing that flight, the safe haven flight. So I think at the end of the day, you've still got a good play. Now, it has broken some very, very, very strong weekly technicals. Now, that in my mind suggests that we've got a lot further to go for gold. 1350, you've seen the price action. We go to new levels, we level off, then we go up again. That's indicative of a market, in my mind, that has a lot further to go.
So what is your sense of the range for the rest of the year for gold prices? Are you looking at 1400 come back yet again?
Well, I think if you look at that range, 1320 on the downside, and that 1320 is that significant trend line or weekly trend line. So if it stays above that level, very positive. But then if we have unresolved matters continuing on the geopolitical front, then I think you can see the metal trade upwards and over that 1400, maybe even up to that 1420 level.
Well, when it comes to the other commodities, what would you want to watch out for? Because there's a whole host of macro data, events, etc., that the markets are looking at, right from weather to geopolitics to political uncertainties as well, and of course the weakness in US dollar. Where do you see the next cue coming from?
Yes, I do. And I think that's an underlying theme that we've now got to live with. I do think the US administration has said to us that they want the dollar, or they've implied that a lower dollar is good for the economy, good for the export market. And we know what Donald Trump wants. He wants US exports to be great again. So I think this is underlying theme for that dollar to remain weak, which will be supportive of the commodity prices, and in particular gold. So I think at the end of the day, when we look at the US and we look at a weaker US dollar policy, it sets the tone, I think, for a lot of our commodity markets to remain relatively well supported.
Jonathan, we also would want your sense on the crude oil prices. They're up nearly 4% in this week, and we have seen the hurricane actually play havoc here. How are you looking at the prices?
Well, I think at the moment we are seeing a test to the top side. When I look at the crude market, I think at the end of the day, everyone wants to see it higher. The only loser is obviously us, the consumer. But when you look from an OPEC perspective, a Russian perspective, an oil shale perspective, a high price is good for them. When we look at what's happening with the hurricanes, I do think that's supporting prices at the moment a little bit. If we do start to get damage, more infrastructure damage, then I think it is an issue. Understand with Harvey, we saw crude under pressure, but I think with Irma it's slightly different, because I feel that if we don't lose more refining capacity and we lose less support, it could be something similar to perhaps what we've seen in Katrina, where there is that concern. But at the moment, weather concerns are underlying that support, which is supportive for the OPEC, Russian and the oil shale producers. But I still feel that it's in a range. The top side of the range, I think, is restricted to 52 and 55 basis West Texas and Brent. And I don't yet see it trading out of that range. Let's see what happens on the hurricane front. But at the moment, I think it's still within the range, but just trading to the top end.
Sure. So before we let you go, Jonathan, what would be your best sector to pick up for the rest of 2017 from all the commodities that we have spoken about?
Well, you look at the precious metal market side. Once again, a significant trend line support has been broken on a weekly basis. That does indicate that it's a buy and dip scenario. US dollar remains weak. Geopoliticals aren't going to go away with Donald Trump there. So precious metal markets remain, to me, a very good sector to invest in.
All right, Jonathan. But always a pleasure talking to you. So that's the view coming in from him, that precious metals is the top sector to pick in, and the other commodities as well. Until the time the US dollar is on the weaker side, you will see some more gains come in there. But let's now shift focus to agro commodities, and we've seen a lot of action there as well. Sugar has seen a lot of policy action ahead of the festival season that sees a surge in sugar demand. The government has taken measures to control prices and create ample supplies in the market. Let's see how the industry is looking at these measures as well. And joining us now is Somnath Chatterjee, Head of Procurement and Logistics at ITC. Somnath, hi, good to have you. And let's start with sugar first. And while there have been lots of measures and that perhaps has led to prices trade in a very narrow range, for a company like yours, how have you seen those changes and whether that has worked in favor for you?
For a company such as ours, a business like ITC, we are into building brands, and creating products and reaching out to the consumer. Therefore, volatility is something which is what we are afraid of. And whenever prices remain within an acceptable band, and that's fine with us. In fact, we can live with it. We can plan for the future, and we don't need to keep changing our price offering or tweaking the grammage of our products. So a narrow band is acceptable. Volatility is what we don't like.
That is quite understandable. But Somnath, how would you call the current sugar prices? Will you say that it is a fair price, it works well with your calculations, balance sheets, etc., or would you be looking at a more somber price from here on?
In real terms, if you were to compare the price of sugar and how it has moved over the last decade, in comparison to other raw materials for us, for instance, wheat flour or edible oils, I think sugar is at the moment fairly reasonably priced. It has been now this band of rupees 36 to 38. We've been seeing this for 10 months and we are comfortable with it. Once going forward, I don't think we are looking at any distress for our business unless and until the ex-mill rate of sugar crosses 40. Till that level, we are more or less reasonably comfortable.
Let's also talk about the edible oil prices, and it's not just sugar that the government has moved on in sense of policy. The edible oil import duty is yet another thing that came in. How would you look at this number and how much of the benefit do you see arising out of it?
Well, Manisha, again, I think had this duty hike happened 2 months earlier, the planting intentions of the oilseed farmers in India for the Kharif crop would have been far clearer. As it is, we are now getting reports that the planted area has been around 6%, planted area for soybean that is, has been around 6% lower than last year. And last year was not a good year anyway to start with, it was a drought year. This year we've had reports of flooding in certain parts of Maharashtra and Madhya Pradesh, which goes soybean. So all in all, we have a scenario where while the imported oil costs more, domestic production may not be as good, and there could be price pressures going on into the lean months of oil, which are typically the Jan to April period.
Somnath, so when you say that the planting of soybean is on the lower side and the yields are not so good, are you expecting then that the kind of monsoon that we are looking at, would you say that going forward we perhaps should be getting ready for the edible oil prices going higher?
That is possible. In fact, the rupee, which is another very important factor in the edible oil that we use, because that's mostly palm and that is all imported. The rupee has been remarkably resilient and it's been quite rock steady at this 63.50, 64.50 band. And I don't really know whether that's going to remain so going forward. Should the rupee go back to the 55, 56 rupee to the dollar level, we have a case where edible oil will get far more expensive than what it is today. In any case, we should not forget that this is the high cycle for palm oil in Indonesia and Malaysia. So production is at its peak, and therefore, if you retake long-term data, you will find that these are the months when prices are usually depressed. If the prices were to go up, which by 200 to 300 ringgits from where they are today, then it will surpass 3,000 ringgit per ton level. And in a combination with 15% duty and rupee dollar to at about 65 levels, we can look at the edible oil prices jumping by about 6 to 8 rupees from where they are today.
But just coming back to that point of cold storage that you just made, the infrastructure, etc., you said that there are some states and there have been some steps taken in that direction which have been positive. What would you say that is still desired to be done in that sector?
Well, there has to be, to my mind, there has to be far more private and government partnership in setting up infrastructure. government should provide some incentives to people. There are incentives in place, but they are few and far between, and a little difficult to get it all together. It should be encouraged, it should be fast-tracked. And today, with the power situation in the country having improved considerably, running these cold stores are far more tenable than they were before. Another thing which I would quickly like to touch upon, Manisha, is the fact that we have a fairly nascent cold chain in India. I mean, some numbers, just some trivia, that in the 1950s, the United States of America had more cold vans than we have in India today in 2017. So, and we have a huge population which is now slowly tending towards convenience foods and frozen foods. So, I think to that extent, GST and doing away with all the toll nakas in the country, that's a great help. In fact, the trucks and vehicles are going to be moving far more faster than they were before. So that helps the perishables anyway. But I think a little more needs to be done. Maybe the government needs to look at a GST rate for cold vehicles which is more friendly. I don't know. But yeah, these are sectors where the government needs to structurally make differences. Otherwise, going forward, you must remember that we need to feed 1.3 billion people. And that's no mean task.
Well, it's not. And yes, as you said, plenty has been done, but much more is desired at this point in time. Somnath Chatterjee, we'll let you go. Thank you so much for spending time with us. With that, it's time for a short break, but we are not done with sugar yet. Sanjay Thapria, director of Simbhavli Sugar, joins us on the other side to make sense of the government measures and prices.